Hi, I'm Rob Bentz. With me is Rob Dix. And yes, you're listening to the Property Podcast. This week, we deep dive into strategy with our part 2 in a 3-part series.
Yes, happy Thursday morning. Best day of the week. Thank you for joining us for episode 149 of the Property Podcast. We are doing part 2 of how to create a property strategy. So if you haven't yet listened to part 1, might be a good time to go back and do that first. If you go to thepropertyhub.net/strategy, you'll find all these episodes and all the notes that go with them. But yet this is such a big and important topic, we are dedicating 3 episodes to it. Last week, we really enjoyed. This week, we're going to really get into the nitty-gritty of different strategies you could adopt. So it should be a good one, Rob.
It should be. And as we mentioned last week, it's probably what we're best at, strategy. So it's remarkable that it's taken us 150 episodes to get to talking about strategy. But we're here, and that's the main thing, and we're giving you 3 juicy parts on it. But before we get going, you've dug out a juicy news story, Rob. I like this one.
Yeah, this is actually a really interesting one. I've got a bit of a problem with house price stories. One of the reasons that I have problems with them is like when you'll get things like house prices have gone up like 3%. And it's just not very interesting to me because that's an average, and averages conceal a lot of variation around that average. And that's why this story is quite interesting, because it shows what's happened to house prices over 20 years in every different electoral ward of the UK. So the headline is that house prices have rocketed 300% since 1995. So if you compare that to the general inflation in the economy over the last 20 years, which I looked up, was 78%, that shows that if you're investing in property, you're doing pretty well over the last 20 years. Then when you start digging into the details of each area, you can see that there are only 5 electoral wards in the whole of the UK where prices haven't doubled in 20 years. But even in those ones where they haven't, every single area has beaten general inflation. So property in general as an asset class over the last 20 years, really good. But the interesting bit, Rob, is when you start digging down into each individual area and see the massive differences between the best and the worst.
So the best is over 900%, and that's Oval in London. Bit of regeneration with the ground there, so that's not surprising that it's in London with regeneration. Nice part of London as well, that's so high. Knightsbridge obviously is up there as well, that's nearly at 900%, and some of the usual suspects. Now, Rob, I completely agree with data, and one of the other things with data with myself that I get sort of wound up by is date selection. So the last 20 years is quite interesting, and it's a fair spread. But actually, we've just gone through a London boom. So the numbers in London you would expect to be a bit higher, which they are. But if we stretch that out further and wonder what the data would be, or if we'd not done the last 5 years, what would the data have been? So you have to always question the data. Headlines are interesting, as Rob said, but when you start to dig in just this set of data, it gets really interesting. And then if you start questioning timelines, it gets even more interesting. However, outside of London, Brighton, as a note, has done particularly well. St Albans, we mentioned on the podcast as well, done very well, over 500% over the last 20 years, which is exceptional. If you've bought in an area with 500% over the 20 years, you'd be pretty happy. Down at the bottom, some areas you may expect to see, some areas in South Wales, some areas that you wouldn't describe as doing so well in the northwest or the northeast. I'm not going to mention particular areas, but not the main cities. But you can, if you have a look at the link, you'll see for yourself. Interestingly, though, Rob, before we switch the mics on, we were looking at this in a bit more detail, and we noticed Bradford being down there as one of the lowest performers. Bradford 118% in the last 20 years. That's one to watch for me. Lots of others in the bottom may not go anywhere. But if you look at Bradford, there's room to grow there because there's lots and lots of regen. And we're not talking a few pounds, we're talking hundreds of millions. So with all that regen going in, and it's starting from a low base, might be one to keep an eye on.
Well, that's the thing. It's like cheap doesn't mean bargain, and low growth in the past doesn't mean big growth in the future. If you look at lots of the areas that are down there, you can see a reason why they're down there, and it's hard to imagine that changing. But if you then have a catalyst, If you have some reason why things would change, then obviously it's starting from a lower position. It's got further to go. So yeah, it's always worth looking out for that. But as you quite rightly say, regeneration isn't just like a new Tesco Metro on the high street. It needs to be fairly significant. But the real takeaway from this is where you invest matters. If you're investing for capital growth and you're investing in some of these places down the bottom, you wouldn't have had a great couple of decades. If you're investing for yield, maybe it's exactly the place for you. And that's why strategy and location are so important. We're going to talk about this a lot more next week in the final part of the episode. But it just shows that having formed your strategy, you need to then look at where to invest. It's possible that you live in the perfect area to execute your strategy, but it's also possible that you live in absolutely the wrong area, depending on what your strategy is. So anyway, that's the news story. That will be linked at the show notes, which this week are at thepropertyhub.net/strategy. Speaking of strategy, before we move on to the main bulk of the episode, worth noting that it's been a busy old start to the year. There's been a flurry of activity in all manner of things. One of those is that both the summits that we're putting on in February are now sold out, which is great. We're very excited to meet all 32 of you. Need to do a quick bit of maths there. But as a result, we've put a date in April on sale. And after that, we're probably not going to be doing one until after the summer. So if you want to come and join us to talk about strategy at a Property Hub Summit, go and have a look at the April date and see if you'd like to come along. Thepropertyhub.net/summit is the place to go.
Now, when we were saying it's going to sell out, it wasn't just one of those things to make you, go quick, it's going to sell out. We knew it was going to sell out. So now when we say, because there's only one day in April, not two, it will sell out quickly. If you've been sitting on the fence of this one, maybe think about taking action. Up to you. It's going to sell out anyway. But we're not just saying it. So I might not say that again because you've had warning, but we've only got one date and that's us until after the summer. So if you're interested, go to thepropertyhub.net/summit and we can deep dive into your strategy. Right, let's deep dive into this episode, Rob. How to create a property strategy part 2. Now, of course, Rob, in your book, The Complete Guide to Property Investment, which is out very, very, very soon, you clearly and obviously cover strategy because that's a huge part of it. And what we're going to do is take some of the strategies that Rob mentions in the book and go into them in detail in this episode. Now, of course, when it comes to strategy, there are dozens, if not hundreds, of different approaches you can take. So we can't cover them all here. But what we're going to cover is the mainstream strategies that you're more likely to approach. Rob goes into much more detail in the book, of course. And as we mentioned in part 1, the reason we've put off doing strategy for so long is because it's so deep and vast. But we're going to give you the core stuff here today. So it's a very, very good starting point. So Rob, the first one we'll go with, we're going to start with long term and then work our way down to sort of shorter term. But if we go long term first, let's go with one that we know very well and it's very dear to our hearts, buy and hold.
Yeah. So buy and hold is almost the default, isn't it? You buy a property, you sit back, you collect rent every month, and then over a certain period of time, its price goes up. It might go down before it goes up. It might go up, then down, and then up a bit more. But eventually, as we've seen from the news story, its price will go up over the long term. And over the last 20 years, not to say that's a guarantee for the future, every single part of the UK has beaten inflation. However, when you get strategic, there's far more to buy and hold than just buying anything. So the typical approach that amateur investors take is they'll just spot a property that's come up near to where they live. They'll realise that they can afford to buy it with a mortgage or whatever, and so they'll buy it. And then they'll try and pay that mortgage down, so that property is owned free and clear by the time they retire, and that property is their retirement. That's not a terrible thing to do. Because conditions have been so benign in the last couple of decades, you really couldn't have gone too far wrong, whatever you've done, as long as you haven't done anything ridiculous. Even people who were doing some pretty ridiculous things around about 2006 mostly ended up surviving. But you can, of course, do far, far better. As a part of doing better, you need to think about whether your priority is capital growth over the long term or making money now. So it's the growth yield trade-off. It's not necessarily a trade-off. It doesn't have to be. You can have both if you buy well. But for the most part, depending on your goal, which we talked about a couple of weeks ago, you're going to be most concerned with either making money now, so you can leave your job or have financial freedom or whatever you want to do, or you want to have your retirement sorted and you want to get some of that capital growth. As a result, and I go into this far more in the book, what you buy and where you buy is massively important. It's all about buying the right properties in the right areas, as we've seen, makes a big difference, and also buying below market value. Because if you buy a property below market value, then instantly you have got some basically free equity in there. So you're ahead before you even start. Then it's got strong growth potential. So you'll watch it grow strongly compared to the UK average. That means that over time, you can either refinance to access that extra equity and expand your portfolio, or you can sell when you've got the growth that you want from that property and you think that there are opportunities elsewhere. And again, we're going to be talking about this kind of thing far more in next week's episode when we get into implementing the strategy. But that is your basic buy and hold with a bit of a growth slant rather than thinking about the income. The benefits of this strategy? Well, it's very, very easy. You don't have to do much other than buy well and then wait. If you pass the management over to someone else, you just buy it and then you are done. It's also pretty safe as long as you've bought properly and factored in enough of a margin for error. You've stress tested against higher interest rates and so on. And as we've seen, growth has been spectacular in the past. We don't know if it's going to continue, but if you buy correctly, then you can make some massive gains over time with very little effort.
So lots of good news around buy and hold. You know, why would you not do it? Rob does it. I do it. We both advocate it for a lot of people, but it's not right for everyone. And that's the thing. Always be aware when someone says this strategy is what you should do if they don't know anything about you. We could say we love this strategy, but it may be terrible for a large proportion of our listeners. And that's because if you are in property to make income fast, retire quickly, then this strategy isn't probably for you. This is very much a long-term view strategy. This isn't get rich quickly, which property shouldn't be viewed as. However, there are ways that you can achieve higher incomes sooner. If you're in for property for the short term, you just have to get out of a job you hate, you're willing to pour the hours in, then there may be other strategies better for you. But as Rob said, if you're more passive and you're in this for the long term, great strategy. Another strategy you could look at is buy, improve, and refinance. So buy, improve, and refinance. So this is where you will look for a property that needs a bit of work, somewhere you can possibly either add value or just bring it up to market standards. So you'll be looking for properties that are possibly a little bit run down, or a property where you've spotted an opportunity to extend or add value where others haven't. Now, this, of course, is more challenging because there's a bit more work to find in these unique opportunities, but it's less capital intensive because after you've improved the property, you'll then refinance, release some of the capital, and then take it to go and invest in something else. So it's a really good strategy. If you've got a limited pot of cash to invest, it's a really good strategy to motor along a little bit faster. It really does help. So this strategy is definitely one for you to consider if funds are low and you've got a bit of time, because you'll be able to recycle, keep building a pot and building your portfolio over the years.
Yeah, and again, in the book, I do a worked example that shows nicely how much it reduces the amount of capital you have to put in. The fact that it's less capital intensive makes it attractive for a lot of people. But you've already said it, Rob, it is more challenging. There's a lot more risk in there. The issue is that whereas the previous strategy is but just long-time buy and hold is obviously long-term. Therefore, if things don't go particularly well along the way, as long as you can hold on through the bad times, it doesn't particularly bother you so much. You're still renting it out. Everything's still good. When you're doing sort of buy, improve, refinance, then you're at more risk of short-term factors. So if, for example, you're trying to add 25% in value so you can get some of your funds back out again, if the market temporarily takes a 10% dive, then it means that you're not going to be able to get the funds back out again as you'd anticipated, and you come to a complete stop until you can. Also, it relies completely on being able to refinance, which means both getting the valuation and being able to get borrowing. If the lending market dries up, then it leaves you in a difficult position as well. So these aren't risks that are unique to this strategy by any means, but it just means if you've got less capital, then you have to work harder to stretch it. You have to get it back out again. And so that means that if you hit any obstacles, you don't have much of a buffer zone. So it is a little bit more risky in that respect. And of course, it's a lot more work. So if you don't have a lot of time to put in, then it's going to be more challenging because it's going to be more effort to source these opportunities. It's going to be more effort to refurbish them and arrange the refinance. So this again is why we talked last week about the importance of understanding yourself and your current position, because while this might sound brilliant, and it is brilliant, right? You get the same pot of money and you use it over and over and over again to build a portfolio. If you have no time, if you're working 100-hour weeks in the city, it's just not going to work for you unless you manage to successfully build a team to help you with that. So it all comes back to understanding your goal, but also understanding yourself. Okay, let's look at another strategy that's more geared towards making money now. So let's say that you've got a job that you don't particularly like, and what you want to do is replace your income from your job with rental income as soon as you can. Buying one or two properties, just normal single lets, isn't really going to make any difference to you in that way. Say you've got two properties that are each making £300 a month in net profit. That's very nice. Far better to have it than not to have it, but it's not going to allow you to quit your job or anything else. That's why people tend to turn to HMOs when they're in search of income now. An HMO means a property that's let out by the room to multiple people. And when you do that, you're able to make more money than if you had the same property as a single let. Often you can take something like a 3-bedroom house, and then you can either subdivide a bedroom or you can turn a reception room into another bedroom to get like 4 or 5 rooms in there, and then rent it out individually and make a lot more gross rental income than you otherwise would have done, because you're taking an asset and you're working that asset far harder than it would have done before. This makes it appealing because you don't need anywhere near as many properties to make the same gross rental income. So rather than having 15 buy-to-lets, you might only need 5 HMOs. So if you're starting with a decent sized pot of cash, because obviously it's not cheap to buy large-ish properties and perhaps convert them and do work to them, but if you're starting with a large-ish cash pot, and your objective is to replace your income as quickly as you can, then doing that with lots and lots of individual properties is going to take you some time, and it's going to feel a bit daunting and like quite a lot of hard work. But if you can just buy sort of 3, 4, 5 HMOs and you're done, then that feels a lot more achievable, and it's not going to take you so long to make those purchases. You can do it quicker. So it very much depends on your objective. HMOs are not something I'm personally particularly interested in because it doesn't fit in with my current goals. But if you do want to make rental income now, then they can be very attractive indeed. They can.
And when I hear from so many people new to property that they want to go into HMOs, and that's the first thing they want to do. And you can see why. Those returns are seductive. You know, you can go, oh, I can make 15% on this. And then they kind of ignore what's behind that 15% return. And what's behind that 15% return is often a lot of your own time. A lot of time. If you are doing a HMO strategy, the chances are you cannot achieve it by going passive. Now, that may mean that the sourcing of the properties and getting them ready for HMO, so all the regulations that are around HMOs now, you have to set them up in a certain way. Even if you're targeting a property that isn't going to require licensing, there are still certain things that will need to be done to make sure it's set up as a HMO. So very, very time consuming. It can be anyway. For most people it is. So you have to factor in your time when looking at the ROI. The other thing about HMOs is you've got a lot of people in one house. Now, if you have a lot of people, you have a few things. You have high turnover because people are coming and going, so you're always having to find new people. So that the maximum ROI might not be the ROI that you're achieving all year round. So you have to factor that in and work out what the true ROI is. And then with people coming and going all the time, you've got the increased risk of wear and tear. And therefore, you have to factor that into your ROI as well, because you would expect to be replacing things a little bit more often with a HMO strategy. So very, very appealing from a cash flow point of view. And a lot of people get sold on HMOs because of that. And the people selling them really do fail to mention all the stress and hard work that goes behind them. Gavin, who works at RMP, he's tried HMOs before, and I'm sure he'll be happy to tell you it's not something he wants to repeat in a hurry. The poor guy looked a mess when it was being set up. He's sticking to buy and hold now. But it's worked out for him in the long term. He may not repeat it, and it has sunk a lot of his time, but he's got that income coming in now. But do not think about going into it if you are time poor, because HMOs is just not the right strategy for you. A great strategy for those with a bit of time on their side and who really, really do need high income now. But if getting high income today isn't a priority, it's a nice to have, but it's not the number one priority, there may be other strategies that are better off for you. So the next one is buy to sell. And buy to sell is really popular. Sarah Beanie made buy to sell pretty popular because most people on the property ladder, they would go in, refurb a property and then sell it on. Of course, Sarah Beanie in the next magazine, which we're very excited about. Go to propertyhub.net/magazine to find out more. But that's one way of doing it. You can buy a property, add value, and then sell it on for a profit. Or you could buy really well, buy below market value. Maybe it doesn't need any work at all. Buy below market value, sell it on, and make a profit. Or if you're someone like Paul Ribbons, you could buy a property, ruin it, and somehow sell it to make a profit. I still didn't know how that strategy works, but I'm impressed that somehow he can pull it off. So there are different ways of going about buy to sell, and you can see why people would want to do it, because you're buying an asset worth a lot of money, you're then selling it for even more money, and then you've got an income. So effectively, if you master this strategy, you can stop working now. That's very, very appealing to a lot of people. So buy to sell, however you achieve it, for a lot of people is very appealing.
Yeah, it's the ultimate cash now. So it's almost not investment. I kind of struggle about whether to call it property investment or not, because it's more really property trading, because you're not investing, which for me means kind of you'll buy something for a mixture of like long-term growth and income. You're buying something because you think in a few months you'll be able to sell it on for more. That means that for cash flow, it's brilliant. It's more straightforward in lots of ways. The downside, of course, is that because it's not strictly investment, it's almost a job or a side business, because if you stop doing it, the money stops. If you've got a managed buy-to-let portfolio, then you could not think about it for a year. And at the end of that year, you could check your bank account and you'd have more money than you started the year with. Okay, I'm simplifying. I think it's very unlikely that you're going to have a situation where you go a whole year without anything cropping up. But the principle is there. With buy to sell, the minute you stop finding the right opportunities at the right price, you stop doing the work, you stop successfully selling them on, no more cash. So again, it completely ties into what your objectives are. I think because of the property ladder effect, people get very keen about the idea of buy to sell, but you've got to look at your goals. It can be exactly the right thing to do. A lot of people also get into buy to sell for a few years to generate more cash than they started with, and then use some of that cash to invest in buy to let. That makes total sense. It can also work really well with a parallel investment strategy. So, for example, you do a couple of projects a year. You put the initial capital back into your next buy to sell project, and the profit you put into a buy to let deposit. Makes a lot of sense as well. So it can be great, but it is basically a job, perhaps a more fun job than you've got right now, and you'd love to do it. That's fine. But again, you've got to think about your goals and not just think, oh, that looks glamorous. People make a lot of money that way. Let's go do it. And then the final strategy we're going to look at, let's go back to buy and hold. Let's go back to normal buy to let. We've talked about some things that are a little bit outside our personal comfort zones. We've talked about HMOs. We've talked about buy to sell. Let's go back to what we know and talk about buy and hold, but this time with a different slant on it and thinking more about the income. So when we talked in the news story about different areas of the country where they've experienced different levels of growth over the last 20 years, There are some right down the bottom where growth has been minimal. However, the yield that you can get on those properties is probably really good. Leaving aside the possible difficulties with collecting that rent and demand and so on, assuming that you can get and collect that rent, you could end up making a really good return. Now, there's a trade-off, of course, because you end up getting less of that growth. But buying a property with a good yield, forgetting about the growth and just letting the rental income pile up is a totally valid strategy. In the next issue of the magazine, which should be hitting your doormat in about a week's time, we've got an interview with someone who's done exactly that. We follow his investment journey as he builds up a really sizable property portfolio that generates income. And it's really interesting because he doesn't mention the growth in value of his properties at all. He doesn't talk about refinancing them as the price goes up at all. And it's very unusual in a magazine because normally you get, I bought this property and 3 years later it was worth twice as much and I did this and I did that. And that's more glamorous. But there's also a lot of power in just buying something that generates cash for you, really good cash, and leaving it. Of course, you can combine this with buying below market value, because if you do, it'll make all the difference to your yield and it'll potentially give you that ability to refinance. So even within buy and hold, and this is a distinction I try to make, you can see it as one strategy, but actually there are loads and loads of different ways of working it depending on what your objectives are.
So it's a good strategy. But what are the downsides to this one? Well, the big one for me, and the reason why I don't take the income slant on buy and hold, is that you've got to consider total growth. So your income and capital growth put together and look at it as a whole. Because actually, you will do better over the long term in terms of the money you will make if you go for the growth slant with the lower yield than an income slant with a higher yield. Because capital growth is the true way to making money in property over long term. You never hear about the person who got rich through rent. You may hear about the person who was able to retire or was able to earn a passive income, but you never hear about the person who became wealthy through rental income. But you do hear, and you hear it a lot, about people who became wealthy through property because of the capital growth. And that's what's important to me, is the long-term growth, the long-term wealth. So if I have to sacrifice a few percentage points on yield today, I'm more than prepared to do that because the growth is far more important to me and my personal strategy. However, as I said before, that's just me. So what I'm saying is right for me doesn't mean it's right for you, dear listener. So you have to make your own mind up. Maybe that is the right strategy for you. But buy and hold is something I do, but I go for the growth slant. However, I can see why people go down the income slant, and it is right for some people.
And this is why this episode is already getting quite long and why we love talking about it but so much, because it's just so interesting, because there are so many different ways of attacking it and you can't say that anything's right or wrong. And we've taken great pains not to do that, because it does all completely come down to your goal and what you're like as a person. It's just, and you just take something like buy and hold, which sounds like one thing and it turns out to be 20 different things. It's really exciting to us and hopefully it's exciting to you as well. But Rob, come on, I said that was the last strategy, but why don't you throw us a little bonus?
A little bonus? This has been in demand. We keep getting told off on the Property Hub about this and other things for not doing stuff we say we're going to do. And one of them is the Ultimate Strategy course. Now, the Ultimate Strategy course has been lying dormant on the Property Hub website for a while because we just wanted to give it a little reboost and a little refresh. So with Rob's book going out next week, in fact, a week today as this goes out, we are also going to give you a double treat and also get the Ultimate Strategy course back up on the Property Hub. So what is it? Well, it's a strategy I teach at RMP Property to everybody who comes in for a strategy meeting. And to cover it on a podcast would be pretty difficult because it's buy and hold, adding a twist, using B&V to accelerate it, and then paying yourself with debt. Sounds crazy. I promise you it isn't. It's actually extremely, extremely effective. And I've not had anybody come in for a meeting and go, that's not going to work. It may not work for them, but as a strategy, it certainly does work. So make sure you check out the show notes, thepropertyhub.net/strategy. And by the time next week's episode goes out, we will have it live. So it might not be live when you listen to this now, but when next week's episode goes out, so a week today, the course will be live on the Property Hub website on the courses page and on the propertyhub.net/strategy. So I'm not going to go into too much detail now because that's why there's a course on it, because it is very, very difficult to explain. But once you master it, once you understand it, it's very powerful.
Yeah, that's the interesting thing. Like all the others that we've talked about is like you say roughly what the name of it is and you get it straight away. And then from there, you can dig into the pros and cons, but you get what it is. This one does take a bit of getting your head around. It took me a while when we were putting this together the first time. But then when it clicks, it's not going to be for everyone. Of course not. Not every strategy we've talked about has pros and cons depending on who you are. But it is very, very interesting. So I'm glad that we are finally going to get this course up and stop people yelling at us. So there you go. There's 5 or actually 6 strategies for you. You can see that they are all very, very different in terms of what they involve, in terms of actually executing them successfully, and where they get you, and when they get you there, in fact. And that is why we're doing these episodes in the order we are. See, there is a plan. The first proper episode of this year, episode 147, we talked about the importance of goals. This isn't just goals for the sake of motivation, although that is very important. It's goals in terms of defining where it is that you need to end up specifically, because that will be a factor in determining which strategy you adopt. We then, last week, talked about the importance of understanding yourself, understanding what your attitude to risk is, what your time frame is, what kind of capital you've got access to, and what your angle is. What is it that you're good at? What is it that you're not so good at? When you put all those factors together, it leads you towards some of the strategies that we've talked about today and away from others. From there, there's lots more digging down to do, but it gives you an idea of which path to go down. And then next week, we're going to get down into the details. So from this, you should be going, okay, well, I want to make money in the short term. Therefore, I'm maybe looking at buy to sell. Maybe I'm looking at buying, adding some value and refinancing. But then there are obviously a lot more questions that come from that. And that's what we're going to be getting into next week.
So you can see this is an absolutely huge topic. And that's why it took up a large section of Rob's book. Make sure that if you are interested in property, yes, you've got the summit, yes, you've got these courses, but if you want to add to it, it's only a tenner. It's not like it's going to cost the earth. Get Rob's book. You'll find links to that as well as everything else in the propertyhub.net/strategy. That should be something you should be bookmarking, because that is piling up with loads and loads of resources. Don't worry if you can't see it now. It's going to go live on the last episode, but make a note of it, because there's going to be a ton of information and resources, and the vast majority of them free, all in one place. So make sure you take advantage of that. What we're trying to build is something that we can just refer people to in future when they're struggling with strategy, because it really will help. So make sure you go to the show notes, thepropertyhub.net/strategy, where you can find links to Rob's book, links to all the resources we've mentioned, and links to all of the podcasts that are in this collection. Right, before we come up and tell you what's happening next week, which I think you can probably guess, let's give you the review. And the review this week comes from Chris BB. And Chris says, I've been meaning to write a review, so here it goes. Since listening to the podcast, it's been worth my time. So much great knowledge. Keep on at it. Wow, Chris, you took a while to write that one line. Well done. I'm joking. Thank you, Chris. We do appreciate it, because it was 5 stars. I've now got a 1 star from Chris next week. Only joking, Chris. We really do appreciate it. Long or short, we appreciate your reviews. It makes us very happy, if nothing else. But it also helps us get found on iTunes.
Okay, so resource of the week this week is going to be the Ultimate Property Strategy course. So rather than giving you an external resource, because we've already been rabbiting on for quite a long time this week, we had something we were going to put in, but we'll save that for next week. And this week, we'll just talk about the Ultimate Property Strategy course and, of course, the strategy page. So if you go over to the show notes, you'll find links to all of that, propertyhub.net/strategy. And next week, we are going to be wrapping up this series by talking about actually putting one of these strategies into action. Very simple, but very important. It's kind of going on that journey from like, okay, I want to invest in property, I get it, to, okay, well, this is what I want to achieve, to this is what I've got in my favor, to, okay, this is the kind of approach that I think is going to be right, down to, okay, this is precisely what I'm going to do and exactly how I'm going to do it. So it's going to be finishing that journey next week and hopefully giving you a lot more clarity on putting this stuff into action.
So remember, go to thepropertyhub.net/strategy. What have we got in there? We've got forms you can fill out for your goals. We've got the goals course. We've got links to all the podcasts. We've got links to Rob's book. We're going to have a link to the ultimate property strategy. I forgot to mention that one. It's extremely tax efficient as well. That's probably one of the most important things about that strategy. Make sure you check out Rob's book. I'm not just saying it because we're friends and co-hosts and everything else. I have read it. It is brilliant, and it really lives up to the title, The Complete Guide to Property Investment. And for a tenner, that sounds like a lot of value to me. The Complete Guide for under £10, $9.99. Definitely check it out.
And you know what's quite exciting? When we've been talking about this in previous weeks, I've been secretly really hoping that it will actually be coming out next week because I was still working on it and still waiting for the final copy to arrive. But I don't know if you can hear this. Don't know if that's been picked up on the microphone or not.
It is. Oh!
I'm actually holding the physical book, so it will come out next week.
Yay!
So that's a relief. And it looks sufficiently chunky, which is excellent. And if you do go and reserve a copy before it comes out next week, you'll get all kinds of extra stuff thrown in for free, such as coming to the exclusive online book discussion where I answer all your questions, plus my extra audio notes for things I couldn't fit in the book and other stuff. So yeah, really, really stretching out what you get for a tenner there.
Rob, go on. We're finished for the episode, so sign us out with one more flick of the book.
There you go.
Oh, love it. We're back next week, everyone. Thanks for joining us. We'll be back with more strategy next week. Until then, bye-bye.
Bye-bye. Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.